Good evening, everyone. So today we'll be analyzing Vivo Collaboration Solutions Limited. So Vivo is a next generation cloud telephony service provider with coverage over 135 countries. So we can see it is a small cap company with the market cap of 19.9 crores. And current price of its share is 98.8 rupees and book value 69.1.
We see that the company's ROC, which is the return on capital employed, is 67.7%, which is a very positive sign for the company because as compared to its opposition companies and its participants and its oppositions, Vivo Collaboration Solutions has a very high rate of ROC, and it also has a very high rate of ROE, which is the return on equity at 50.2%, which is a very positive sign to invest in a company. The pledge percentage is 0.00%, which is also again a very positive sign. Promoters holding, which signifies that the promoters have 73% of signifies that the promoters have very much faith in the company, and it shows that it's a very safe investment.
Now about profit and loss account, we can see that the net profit it has increased with a huge margin. Like it has almost it has become 4 times or 5 times between 3 years. And for the sales, we can see it has also increased from 9.02 in March 2019 to in March 2022 it is 12.83, which on average has increased, but there's also a negative sales growth ratio. It could be because they have reduced the price because of so we can say that in the future the sales could increase, but due to reduce in price, although the sales growth ratio is negative, the profit is increasing, which makes the company safe to invest in. And for the balance sheet.
So when we look at its balance sheet, the share capital is increasing, reserves are even increasing, and borrowings are zero, which is even nice, and fixed assets are constantly increasing. Maybe it is at a smaller ratio, but in for trading purposes, I think this is a good company till now. So when we look at its shareholding pattern, the promoters are constant and the public contribution is even constant.
Now we'll move on to its graph analysis. So if we look at this graph, now first we have to understand what exactly is a PE ratio. PE ratio is the method called price earning method, which gives us the actual price of the share through the earning per share of this company. Now, since earning per share has been constantly increasing and the price is constantly decreasing, this means that PE ratio is also falling. That means we are getting the PE ratio in comparison to its peers and its competitors at a very lower price, and its actual price is actually very lower. As you can see, since it is a very new company and its IPO has been just launched in February 2022, the sudden inflow of IPO and has significantly increases its sale of share, which also means that we are getting the price of this share at a very lower price than its 200 DMA and its 50 DMA, which is a very good sign for trading purposes, as it is starting to take momentum and will rise again. So all in all, this company is a very new company. That means it is moving towards the future, and we have faith that if we invest in the company, we'll surely get the gains. Thank you.
Here the median PE is 7.0, whereas the current PE is 4.2. Since it is lower than median PE, therefore it's a good company. In the end, when we look at its pros and cons, company is almost debt free and company has good return on equity even. And cons, though the company is reporting repeated profits, it's not paying out dividends. So But although we can see that returns are high, so I think for trading purposes, it's a good company. Thank you.